I think by my reckoning it's 11 o'clock. We should probably get going. I'm back at home after last week's problems with the internet in the office. So hopefully things will run a bit more smoothly this time. The guest this week is Craig Baker of Alliance Trust, who's been on before, but actually not for a while. So it'll be interesting to see how that fund's been doing since we last chatted. But a few bits of news to have a look at first. So this week I'm going to be looking at NextEnergy Solar, Roundhill Music, and ThomasLloyd Energy Impact. So NextEnergy first, as you can see, there's the chart. And like many of these renewable energy companies, there's been a sort of growing disconnect between the NAV and the share price in recent months. Although actually it's been sort of flirting with trading asset value for longer than that. I think that is completely undeserved, but we're going to dig into that a bit more detail. What they announced this week is that they're going to sell 5 of their assets from it's a portfolio of subsidy-free solar, so things that were built too late to get the renewable obligation certificates that were in place until 2016. So those are the 5 plants there: Hafford and Whitecross, Staunton, the Grange, and South Lowfield. It's quite a big chunk of their portfolio, so I'll show you in a minute. The idea is they're going to use the money maybe to pay back debt, to buy new stuff, or to buy back shares. So these are some of the largest generating plants in the portfolio, because they're also, I suppose, because there's some of the newest ones as well. Carthew and Whitecross we made fuss of before because they got contracts for difference arrangements in the last government auction round. So they've got really visible cash flows out for years, because those are sort of 15-year index-linked arrangements. Staunton is a bit older, and I think it just sells power through the spot market. But the other 2 have got long-term power purchase agreements, so again, they're quite sort of similar, predictable cash flows. As I say there, so they're going to use the money to maybe pay back some of the debt and to buy new assets and buy back shares. I mean, just on very, very rough calculations, it's difficult because it's not completely equivalent, but Bluefield, I think, said in the last note that we wrote on them that the sort of valuation range was about 1.25, 1.45 million a megawatt. So that's easily 300 million quid for this lot, and maybe more. So it's really quite a chunky amount of money. They've got a revolving credit facility, which many funds have just been using to make acquisitions. They've actually got about £205 million worth of facilities, and they've drawn down about 166 million of that. Obviously, because it's a floating rate debt, so 120 basis points over, well, SONIA's the new equivalent of what was LIBOR. So we're at about 5.4% at the moment. And obviously, as that's been ticking up, then the attractions of having this debt have been going down. So it does make sense to pay this down. And I think if they manage to sell the whole lot for the sorts of numbers that I'm talking about, they can probably wipe out all of that debt if they wanted to. They've got a £500 million pipeline, though, that they quite like to get on with. And this goes across the whole industry. And one of the slightly frustrating things, or actually very frustrating things about the discounts that have opened up on the renewable energy sector, is that there's still a huge amount to do, an awful lot more money needed. And it's important, I think, that a big chunk of that money comes from our industry. We've been quite good supporters of the whole need to tackle climate change. Particularly in things like batteries, which is something that NextEnergy wants to have a real go at. So it's got a 250 megawatt battery project, which is developing east of England, but that's not all. It outlined its battery storage plans not that long ago, and we talked about it then. So they won't do all of that £500 million pipeline, but they will have some money to do some of this. And I think once the, well, if the interest rates normalise, well, normalised, maybe they're normal now, but if interest rates come back down again a bit, which I think is quite likely, then they might be able to ramp that revolving credit facility back up again and use some of that to fund some of this stuff. And obviously the attraction of investing in new projects is that it drives the NAV growth. Buybacks, though, given where we are with the discount, would be quite useful. They seem to be, they seem to be saying that they are giving this serious consideration. They aren't planning to buy back until the end of the close period. So at the moment, there's a sort of period between end of March, which is their accounting year end, and 19th of June, which is when I think they're planning to publish the results, where they're technically kind of inside on their own numbers. So it makes it awkward to buy back stock. It can be done, though. You need all sorts of waivers and things. But at the moment, they're not planning to do anything about that until then. But it does give you a sort of encouragement that something will happen in the future. So all good news, I think, with this. And it's quite encouraging that they are thinking outside the box and selling stuff and recycling the money, rather than just sort of sitting and hoping for interest rates to come back down again. Roundhill, that share price and NAV decoupled not so long ago, but to a very large extent, as we can see there. The discount's really gone out about sort of 50% mark. It'll tick upward recently, partly related to the results that it's announced this week. We've talked about this before, so I won't dwell on this too long, but it's broadly diversified fund by genre. It's got a sort of bias to older songs compared to Hypnosis, and they say that makes their whole revenue a bit more attractive, although we just don't know yet. And it's got a split of publishing revenue, which is like song rights, and masters, which is the so one is the publishing is the artists recording things, and the masters are to the sound recordings, and that masters is quite a big chunk relative to Hypnosis, and that they think is actually quite attractive. One of the criticisms that's been levelled at these two funds, they both use the same valuation agent. And there's both a sort of suspicion, I suppose, that valuation agent has been a bit too easy on them. The NAV that they are using is based on an 8.5% discount rate for its cash flows going out, and that hasn't changed since December 21. So it hasn't budged all the time that rates have been going up, and I think that's one of the reasons people are a bit sort of suspicious. On 13th of April, when they said they'd run their numbers, the NAV then was 128. Actually, the numbers that they've just come up with in the accounts is 127, but they're just minor accounting type stuff. But there are two NAVs there. So one is this economic NAV, which is the larger number, and the other one is the IFRS one. The big difference in this is that the normal accounting NAV basically assumes you've bought a portfolio of rights, and the value of them amortizes over a period. So basically the value of those is going down. But I say the economic reality is that's not happening. And so there is an opening gap between what the IFRS NAV says that they're worth and what the economic NAV says they're worth. And the economic NAV is where they think they could sell the songs on. So that's obviously important. That discount rate, I said that Christian described, changing it by 1% would make a big difference. You can see there. It's actually a bit more on the upside than downside. I'm not quite sure why that is, but there we go. But nevertheless, so the 1% on discount rates would take about 15% off the NAV. And that is obviously quite material. And I think that is probably why the discount opened up. But 15% off the NAV is not the same as 50%. And I don't think discount rates would go up more than one, maybe 1.5. So it does feel like the discount's overdone. Now, because they were worried that people didn't really believe the NAVs, they commissioned another valuation report from FTI, which looked at it in various different ways. And they also referenced the prices that things are changing hands at in the general sort of market. And those prices do seem to be consistent with their valuing the songs. But they do note in the accounts that fewer deals are completing because sellers have maybe an unrealistic expectation of where pricing should be. So does that mean that prices are going down? It's really quite hard to tell. For the moment, they're saying there's enough deals at the sort of valuation range that they're using to justify them continuing to use that. Those are the numbers. Well, it's not going to be into those. You can read the thing that we wrote at the time. But basically, although they cut it different ways, the FTI numbers came out more or less the same as the central Cooperman ones. They're only about 3% lower. And then part of it was because that FTI was assuming that cash flow would grow faster than central Cooperman were. When you look at the numbers, it's all moving in the right direction. And really quite a big jump in revenue. They talked about whether they considered buybacks or not, and they said that they'd only be able to do that if they borrowed more money, which obviously wouldn't be a good idea. But given what we've just been talking about with NextEnergy, and I think it's not the only one, that I think some of these, more of these funds are thinking, well, why don't we just sell something and use that money to buy back stock? Because you have the double whammy of proving that the NAVs are right, and doing something material with the discount. And to my mind, I think that's maybe what they should be thinking about. I know they've only just put the portfolio together, and they maybe think that's a daft idea. But given where valuations are, I think it wouldn't really make quite a big impact. Definitely, the numbers were all going in the right direction. It's really quite encouraging that you look at all of this stuff. Synchronization is where they're using the songs in things like films and adverts and stuff, and that's part of what these firms are supposed to be doing is running around trying to sell rights to people, and that is to seem to be working for them. It also helps that the whole industry agreed that songwriters would get a bigger share of the income going forward. So that was 10% a few years ago, and that's up to 15.35. They've also been driving more and more license fee arrangements with big streamers of music, some of which weren't paying anything at all before. So Twitch is just the gaming streaming thing, and Roblox, which is Minecraft. They've actually managed to extract some money out of them for the first time, including some kind of back payments for things that they should have been paying. But they're talking to a whole range of other platforms as well. So all of that is helping things moving in the right direction, and that's partly where this earnings is going to come from in the future. On the debt side of things, they did rejig their debt facilities, but Roundhill have kept theirs on a floating rate as opposed to Hypnosis, which fixed theirs. And it is quite expensive, 7.25. Do you remember I talked about Hypnosis, and I reckon that they weren't earning enough cash to actually cover the dividend, cover the interest payment on the stuff that they funded with debt. I think that's probably true too. Here as well. Nevertheless, the debt isn't outrageous in this structure. It's 17% of economic NAV with a cap of 25. So there's a lot of headroom in there, even if the discount rates go up and the NAV goes down. One last thing. I do think that these funds are all about whether they can actually get the cash flow through, because the accounting is quite complicated. There's a lot of moving parts going on. Cash is a bit more tangible. And here, just stripping out all the other things that are moving around, this is the cash that's being generated by the fund, including it's also got a stake in this thing called Carlin, and I think that's where that 3.5 million quid came from, or dollars rather. They're paying the interest on the bank debt, obviously, and I think that's going to ramp up a bit going forward, but they're also paying the dividends. So they're not quite generating enough cash to finance all of that at the moment. But it is a much improved number from where we were last year. I'd like to see it positive. I think that would give people an awful lot more confidence in what's going on here. Lastly, ThomasLloyd. This is one of these funds that is not very old. It's one of the few that was trading at a premium before all of this happened this week, because the whole sector's derated and it hadn't. And I think it's because it's actually quite thinly traded. But they've got a problem. So unlike all the other funds, this one is investing a bit in emerging markets, where the returns should be higher, but obviously you get a little bit more risk. And it has bought a portfolio of solar stuff in India, much of which is under construction. And as the accounts were being put together, for its first set of accounts, it says they've not actually reported before. They've done the interims, but not audited accounts before. The auditors have said, we don't think actually, given that the cost increases that we've seen in price of components and construction costs, that this 200 megawatt solar asset within the Solarise portfolio is not the only thing they're doing by any stretch of imagination, is actually economically viable. So either you're going to have to put more money into it or walk away from it. And it was valued at close to $14 million, which is about getting on for 8% of the NAV. So that would be quite a big hit if they have to sort of write that off. There is something else going on with the liabilities, which I think I've found it. I'll show you in a second. But because it can't agree what's going on here yet, it hasn't been able to publish its accounts yet, and that means that it's trading suspended. And I think we can predict that even if it all comes back and it's all rosy, given the frustration that people have about the suspension and the uncertainty that this all creates, that it's going to shift to a discount, it's obviously massively unhelpful. But there we go. Maybe that's just the risk of doing emerging market stuff here. This is the tossable liability. It's the other major projects I've got are in the Philippines. This is the holding company for that. There was a kind of conditional liability there, which you read all the small print. Basically, they're thinking then that they don't actually have a liability. It may be that the auditors are saying they have to put something in, which of course that's going to make another big difference to the NAV, if that's true. But I'm not sure that's definitely the thing that they're talking about, but that seems to be the most likely thing. So that's enough from me.